What we're going to talk about here are the options for raising business finance and how the various options differ and what kinds of things you should look out for when thinking about raising business finance. Business finance is the term that we use to cover getting more cash into a business in order to make it sustain and grow. The money is used positively to support business growth through investment in products, services, people, or equipment. Finance can come internally or externally. Internally means using your own money from retained profits to grow the business. Whether that's taking on new staff, buying new property or equipment, or investing in new product development. What we're going to talk about for the rest of this session is external finance, using someone else's money to grow your business. The first option is grants. Grants are typically offered by the public sector, local authorities or government organisations, or sometimes charitable trusts in order to support you in achieving a specific outcome. Grants are commonly described as free money in that there is no expectation that the money will be repaid to the funder, unlike loans. However, this isn't strictly true. Grants are the funder's way of buying outputs, outcomes, and impacts from you. So, what do I mean by that? Grants are typically offered by local authorities for a limited time for a specified amount, usually capped at a maximum sum or percentage of the project costs, and for a specific type of activity. They're usually competitive and require businesses to create and submit a funding application. In that application, the business, you, will then detail what you need the money for, how it will help your business to grow, and what the grant will result in, usually business growth, measured by increased staff numbers, new products or services launched, greater turnover, or enhanced profitability. So, you submit your grant application. Let's say you're applying for £25,000 to buy a new piece of equipment that will cost £100,000. And in your application, you say that you'll need to increase your workforce by 2 full-time staff members in order to make the most of the business growth opportunity. Your application then goes into an assessment process, commonly a grant panel, and assuming you're successful, you will then get a grant offer letter. That letter will offer you a grant, in this case £25,000 towards a new piece of equipment that will cost you £100,000, and state that you have committed to creating 2 new jobs as a result. In effect, this grant offer becomes a contract between you and the funder. So if you fail to create these 2 new jobs, or whatever outputs you suggest in your application, there is a risk that you could be deemed to have broken the contract and have to repay the grant in part or in full. In reality, of course, that's unlikely to happen unless your application was totally fictional or fraudulent. But we would urge you to be careful not to be overly ambitious with your expectations for what the grant will do for your business. Most grants will only pay you after you've fully funded the project that the grant is supporting. In this case, you need to have paid for the £100,000 piece of equipment before you can reclaim the grant funding. Grants won't pay towards the VAT element of any purchase. Again, this means you have cash flow consideration. Grants typically require you, the business, to own an asset outright in order to generate grant funding. So this usually rules out hire purchase or asset financed investment, as the asset is usually owned by someone else, at least until the end of the finance period. The next area of external business finance that we're going to look at is debt. Debt, or borrowing, comes in many different forms and from an increasingly large range of sources these days. We're going to look at the principal ones here, but do take independent professional advice if you're considering debt finance options, as there are a lot that may not be suitable for you. Secured loans. These are traditional business loans, a bit like domestic mortgages, where you can borrow money against the value of an asset that you secure the loan against. The asset can be buildings, equipment, stock, or the business itself. Secured loans are typically cheaper forms of business borrowing, as the lender has a lower risk given that the debt is secured against usually something that has a higher value than the debt. Unsecured loans. These are, as the name suggests, loans given to businesses that don't have or aren't willing to offer assets of value to secure the loans against. To the lender, these are much riskier forms of finance, and consequently they are very much more expensive than secured loans. Sometimes with higher application fees and eye-watering levels of interest, used with extreme caution. Startup loans. These are specialist business loans aimed to support those businesses in the very early stages of trading, from start-up to 36 months of trading. They're usually cheap, currently 6% per annum fixed rate, easy to apply for, offer flexible terms of 1 to 5 years, and don't have any application or redemption fees. Overdrafts. Many of us will know about overdrafts from our personal banking experience. Business overdrafts are just the same, expensive but easy access borrowing to cover short-term cash flow issues. Be careful of how expensive overdrafts can be, but they can be very useful and cost-effective if you only need to access the money for a few days at a time. Asset finance. These are funding options designed to help you bring capital, equipment and items into your business without having to pay for them fully or upfront. In effect, you're getting someone else, a bank or other funder, to buy an asset for you, and then you pay a regular fee, typically monthly, for the right to be able to use the asset, typically over a fixed term. There are many different variations of asset finance, from leases to hire purchase agreements, but they all offer options to spread the cost of assets or equipment over a period of time, often 3 to 5 years, the term. Invoice finance. There are several variations of this, as well as different terms, invoice discounting or factoring, but they all operate on the same principle. They all offer you the chance to convert your business invoices into immediate cash in exchange for you giving up a percentage of the invoice amount. This means that you get cash into your business much faster than waiting for customers to pay. Bear in mind that some large commercial customers can pay as many as 60 days after receiving your invoice. But it does mean that you lose a chunk of the invoice value and therefore profit. This option isn't for everyone, but can be useful for those businesses that have late paying customers but with very little bad debt and relatively high profit margins. Finally, we're going to take a brief look at equity, the process of selling shares in your business in exchange for someone else's money, an investment. There are 3 main types of equity finance: business angels, crowdfunding, and venture capital. Business angels, these are private individuals who invest in your business, normally early stage, and hold that investment for around 3 to 5 years. Most business angels have a successful track record in business and so can support your business with their experience, connections, and advice, as well as their cash. As well as wanting to see the value of their investment increase, they do have an interest in that early growth phase of a business and genuinely want to help others succeed. Most business angels don't wear a badge to advertise that fact, as they get swamped by people wanting their money. And so they can be hard to find if you don't know or can't access their networks or gatekeepers. The good news is that there are more and more local and regional networks of business angels establishing all the time. And we have our own network here in Lincolnshire, the Lincolnshire Business Angels Network, which does exactly what it says on the tin. Crowdfunding. This is the process whereby lots of people invest typically small amounts of money collectively and through a website called a platform into a business for a specific project. Although we've categorised crowdfunding under the equity section, in reality there are 4 types of crowdfunding platform. Donation, where people gift money. We've probably all used one of these to support a friend or family member to run a marathon or similar. Reward, where you get a reward, maybe a pre-launch product or a ticket to a show before they open to the public in exchange for your money. Debt, where websites aggregate money for many individuals to lend to a business. And equity, lots of people investing small amounts of money in exchange for a very small share in your business. There are many different crowdfunding platforms out there, so please do seek and take advice before deciding to raise finance through one. Some of them can be quite expensive. There can be risks if you don't get offered 100% of the finance you're after, and they all require you to do quite a lot of hard work. Finally, for this section, we're going to mention venture capital. We're going to use this as a catch-all term to describe commercial funds that invest cash into businesses in exchange for shares. There's a wide variety of funds investing government money, our pensions, corporate money, but they all operate on broadly the same principles. To be of interest, you must have a good track record in the business that you're seeking finance for, typically at or above £100 million per year in turnover, have good growth potential, have a strong team, be open to additional external influence, directors on your board, and be prepared to regularly report your business performance against a set of indicators provided by the funder. To summarise, there are a number of options when it comes to raising external finance for your business. All of them have pros and cons and elephant traps you should avoid. Getting it wrong can be very expensive, both in money and time. So it's important to get good, impartial advice. Banks, accountants and professional advisors will generally steer you in the right direction. And of course, don't forget that the Business Lincolnshire Growth Hub has a specialist advisor who can help. Also, remember that businesses may need different types of external finance at different stages of their development and growth. Finally, raising business finance typically takes longer than people expect. So, as soon as you think you're going to need business finance, assess your options, seek advice, and plan carefully. Thanks for watching.